The money in your bank account isn't really there, not in the way you think. Right now, somewhere in your city, someone just walked into a bank with a salary check. The teller smiled, the screen blinked. And a few keystrokes later, new money quietly came into existence. No printing press, no armored truck, no gold vault opening. Underground. Just numbers, just permission. Just a legal trick hiding in plain sight. And the strange part, this is the system holding up the entire modern economy. So let's talk about how banks create money out of nothing, legally, every day. At a scale big enough to decide who gets rich, who stays stuck, and who gets crushed. When things go wrong, because this matters right now, interest rates are high, debt levels are record-breaking, banks are fragile again. And most people still think banks only lend out the money to other people deposit. That belief is comforting, it's also wrong. Here's the story most of us were taught. You deposit $1,000 into a bank. The bank keeps it safe, then it lends some of it to someone else. Simple. It feels clean, logical, almost moral. Your savings help someone buy a car, they pay interest, the bank takes a cut. Everyone wins, except that's not what actually happens. Let's slow it down. You walk into a bank with $1,000. You deposit it. On the bank's balance sheet, two things appear. A liability. They now owe you $1,000. An asset. They now hold $1,000 in cash or reserves. So far, nothing magical. Now the bank approves a loan to someone else. Let's say $900. Here's the moment that matters. The bank does not go into a vault, take out your $900 and hand it to the borrower. Instead, they open a new account. They type $900. They click confirm. And just like that, a brand new deposit exists. No one else's account went down. Your $1,000 is still there. The borrower's $900 is now there too. Total money in the system. It just increased from $1,000 to $1,900. Nothing was transferred. It was created. The bank didn't lend out existing money. It manufactured new money by issuing a loan. This is not a loophole. This is not a conspiracy. This is literally how modern banking works. Every major central bank on earth admits it. The Bank of England put it bluntly in 2014. When a bank makes a loan, it creates a deposit. That's it. That's the trick. Loans create money, not the other way around. And now the uncomfortable part. If banks can create money whenever they issue loans, what stops them from creating infinite money? The answer sounds technical. Capital requirements, reserve requirements, risk models, regulations. But the real answer is simpler. Profit, fear, and central bank backstops. Banks don't create infinite money because they still need borrowers who can repay. And because too much bad lending makes banks collapse. But within those limits, they create most of the money you use. Not governments, not central banks, private commercial banks. Over 90% of money in modern economy is not cash, it's bank deposits created through lending. So every mortgage, every car loan, every corporate credit line, every student loan, those aren't just debts, they are new money being injected into the economy, which means the money supply isn't controlled directly by government. It's driven by how aggressively banks choose to lend. And here's where it gets weird. When you pay back a loan, that money disappears, the deposit gets delayed, the money supply shrinks. So money is born with debt, and it dies when debt is repaid. That means the entire system needs continuous borrowing just to keep the same amount of money in circulation. No new loans. The money supply contracts. Businesses fail, people lose jobs, recession begin. So the system quietly depends on expanding debt forever, not because someone planned it that way, but because of how money evolved. Now let's zoom out. Why are banks allowed to do this? because we needed credit to grow economies, factories, homes, infrastructure startups. No society builds highways and power grids using only saved cash. Credit accelerates development. So we outsourced money creation to private banks and told them, create money when you lend, destroy it when it's repaid, and try not to blow up the system. In return, banks earn interest, which means they profit from creating money. That's the incentive. They don't make most of their money from fees. They make it from interest on money they created for free. Let that sit for a second. If you had a license to create dollars and charge interest on them, how careful would you be? Sometimes banks are cautious after crashes, after scandals, after regulation tightens, and sometimes they go wild. Housing bubbles, tech bubbles, corporate debt bubbles. When times are good, banks loosen standards. They create more loans, which creates more money, which pushes asset prices higher, which creates the illusion of prosperity until it doesn't. Then defaults rise, loans go bad, money gets destroyed, and suddenly the system needs rescuing. That's when central banks step in. They lower interest rates, they inject reserves, they buy bad assets, they promise liquidity. Not to save you, to save the banking system that creates your money. Because if banks stop lending, the money supply collapses, and everything else collapses with it. This is why governments always bail out banks. Not because they love bankers, because they can't afford a world where money vanishes faster than people can earn it. And here's the quiet irony: the public still believes governments print money and hand it out, but when central banks print money, most of it stays inside the banking system as reserves. It does directly enter your wallet. The real money that hits the real economy, that comes from banks making loans. So when politicians say they're controlling inflation by raising interest rates, what they're really doing is trying to slow down private money creation, make borrowing more expensive, make banks lend less, shrink the flow of new money, which also slows the economy, which causes layoffs, which causes political anger. It's a blunt instrument, and it barely works because banks don't lend based only on rates. They lend based on confidence. When they feel safe, money floods out of nothing. When they feel scared, money evaporates. And this is where the public story completely breaks. We're told money is scarce. We're told governments are broke. We're told budget must be tight. We're told there's no money for health care, housing, or infrastructure. But there is always money for bailouts, always money for wars, always money for stabilizing markets. Because money isn't scarce, creditworthiness is. And power decides who gets access to freshly created money first. As owners, large corporations, financial institutions, they get first access to new money at low rates. They buy assets, prices rise. Then the money slowly trickles down to wages and rent. By the time it reaches everyone else, prices are already higher. That's why inflation feels like theft, because new money enters at the top and costs are paid at the bottom. And the system pretends this is neutral, mechanical, just how things work. Now let's say something slightly uncomfortable this system in. Broken, it's doing exactly what it was designed to do. Channel money creation toward borrowers deemed safe, which usually means people and companies that already have assets, which means inequality, is not a side effect, it's a structural outcome. And it gets worse because debt has to grow faster than incomes to keep the system liquid, which means households become more fragile over time, more leveraged, more exposed, more dependent on low interest rates. That's why rate hikes cause chaos. Not because people suddenly can't afford things, but because the entire money supply was built on cheap debt. Now for the quiet absurdity. Banks create money, but they don't create the interest. The interest has to come from somewhere else in the economy, which means collectively borrowers owe more money than exists. So someone always has to default or take on new debt to pay old debt, which is why crises are not accidents. They're pressure releases. Now here's the part no one likes to say out loud. This system only works if people don't. Think about it too much. If depositors don't all show up at once, if borrowers don't all default at once, if investors keep believing, if governments keep backstopping, if central banks keep cutting rates when things break, it's not fake, but it's fragile, and it runs on trust. Trust that numbers on screens will still mean something tomorrow. Trust that deposit are there even though they're not. Trust that debt will keep expanding. Trust that someone else will take the risk later. And every few decades, that trust cracks. The math becomes visible. The bailouts happen. The anger spikes. Then the system resets. And the story gets forgotten again. So when you look at your bank balance, you're not looking at stored money. You're looking at a promise backed by debt, backed by regulation, backed by government force, backed by collective belief. And the wild part. It works until it doesn't, which brings us to the final uncomfortable thought. If money is created by banks and destroyed when debt is repaid and requires endless borrowing to survive, then what happens in a world that finally tries to use less debt? And if that world can exist? What does that say about the future of a system built on money created from nothing? That's the part no one has an answer for yet.